Joining me today is Alan Smith, President and CEO of Rockcliff Energy. Alan will also join us in October for Hart Energy's Doug Haynesville conference. We're looking forward to that, but before then, we know we have to get through the next few months, Alan. My first question for you, you're currently running 4 rigs. Has your rig count changed this year? Are you expecting it to change approaching winter? I know there's so many unknowns still.
Well, good morning, Jessica, and it's good to be with you. And, we've been busy. We acquired these assets back in late 2017. We set a plan in place at the time, which included 4 rigs. And we had some time there before we got ramped up, but it was in early 18. We've been running 4 rigs ever since. To your question, we did do a little bit of stress testing this year and ran some additional models and decided with the private equity model and with what we've charged ourselves to go out and do, the 4 rig model creates the most value for what we're trying to do. The big thing that you have to look at is, well, everyone thinks that we're sitting here at a $1.70 gas price. Does that make sense to still, run that many rigs? Well, with the cost reductions that we've had, with the continued performance that we've continued to experience, we're still seeing quite robust returns, right around 50% IRRs on the current strip. And that really drove the decision to continue to run these 4 rigs. We also are blessed with a fairly significant hedge book. We always like to, we can't control the commodity price. We know we're not good at that. So when we buy an asset and as we see our drilling program, we always like to hedge into that. And we've hedged a significant amount of our volumes this year in 21 and 22. So when you put all those ingredients together, we're going to continue to run 4 rigs through the year.
Alan, let me ask you, with the market, basically saying we have plenty of gas, why would Rockcliff continue to run 4 rigs?
Well, that's a great question. The way that our model works is we're incented to convert molecules on the ground to cash flow because we made a significant investment on the front end of owning the assets that we own. Therefore, we have that preferred return that we have to pay to our investors. So we're incented to try to get our proved developed producing, reserves and value up. And in this environment, people aren't as interested in paying you a large number for your acreage, for those molecules in the ground. So we're incented to move those molecules from being in the ground to cash flow. And when we do that, that value creation, is what we're really trying to achieve. And, down the road here in the next 12 to 18 months, depending on what prices do and what the capital markets choose to do, we'll be very well positioned, I think, for a good exit.
What's your view of winter gas supply, given the reduction in associated gas that we know is forecast to be offset somewhat by the reduction in LNG demand? Could you share your thoughts there?
Well, it's been a bit of a roller coaster, as you know, and I don't think any of us certainly saw COVID coming and what that ultimately has done, certainly to the oil demand, which has had a huge impact on the associated gas. I think that a lot of people were counting on those shut-ins, and then that was going to really reduce the associated gas. And with the rig counts down, that was going to end up putting us in a very short position of natural gas very quickly. As you know, some of the shut-ins have begun to ease, and I think that the analysts that are looking at this are saying, well, that's going to put more pressure on gas prices. But what we're really focused on is a little bit longer term than that. So we're looking at the capital spending part of the equation. And if you've kept up with that, which I know you have, is, that we're looking at on average somewhere around 40% reductions. That's pretty easily seen whenever that you look at the rig count at roughly, I think this week's 258 rigs, down almost 700 rigs from a year ago. If you look at the gas rigs are around 75 to 78. That's also down, very significantly down from like 175 rigs. So I think that what we're going to see play out over the coming 12 to 18 months is this decline that we're going to see because of that rig count reduction, that capital reduction. Once we see the demand side of the equation begin to come back, that we're definitely going to see going to be in a place where we're going to be short gas. And I think that's going to definitely create some volatility, in the natural gas commodity, and probably to the upside. The question will be always weather plays a big role, and we're obviously off to a pretty hot start for the summer. It'll be interesting to see what happens in the winter. But say we have a normal winter, then I think 2021 is going to be we're going to see some fairly robust natural gas prices.
What about OFS costs? Are you seeing lower OFS costs as firms have spare capacity in equipment and crews?
Yes, over the past year, we've continued to see some softening there. Obviously the big knobs for us are the drilling rigs and the frac crews. All the other equipment is very important. The other services are very important, but we have seen those rates come down. I think that the folks running the rigs and the folks with the frac crews would like to see, those rigs stay hot and see these frac crews stay hot. And I think from the position that we're sitting in, it's worked out well for us because, we are committed to running 4 rigs, for the foreseeable future. And so we certainly benefited from that. We've also seen efficiencies though. And with the work we're doing and how that we're approaching, the type of fracs, the type of stage spacing, and the type of fluids and different types of stage spacing that we've utilized has caused us to be even more efficient as well. For instance, a well in the Haynesville for a 3-string well was roughly $13.5 million, 2 years ago. We're drilling those same wells today for, call it $11.5 million, completed well cost. And that is a function of efficiencies and reduced full service costs.
Alan, let me ask you about the Haynesville comparing to the Marcellus. Is the Haynesville's performance well understood, you think, by the investment community, or is more awareness still needed?
Well, that's a great question, Jessica. When you look at the Marcellus, you see a lot of publicly traded companies in there, 6 or 7, well-known publicly traded companies that are playing, there in the Marcellus, the Utica area. That's not necessarily the case in the Haynesville. A lot of those guys sold out. The larger companies sold those parts of their portfolio, and now you have a significant, private company presence in the Haynesville. As a result of that, you don't see as much of those results getting reported on a quarterly basis, and therefore it is not well understood in our opinion. And so we've been on a bit of a crusade. To speak at your conferences, to be able to tell the story in the Haynesville. There's certainly a very core aspect of the Haynesville that people have known about for a long time. It goes back to 2011, 2012 over in Louisiana. What we've done in East Texas is even less understood. When we did all the mapping, we saw that we were thicker over in Texas than they are in the core. Rock quality is not quite the same, but we're thicker. So we have more gas in place. And when you look at comparing the results, we're really an extension of the core. We are seeing very similar results to the core, which I don't think is well understood. We're a little bit shallower, so our costs are a little bit less. The whole basin enjoys the lower cost basis. With the basis differentials, we're close to the markets, and that makes a huge difference whenever you're comparing the Marcellus to the Haynesville. For instance, our cash cost is, right at, $1, and average the 6 or 7 Marcellus players, they average out to about $1.72. So you say, why is that a difference? Because they do have good rock. Their operating costs are low. It's really driven by the midstream. It's driven by the GTC costs, which are have those minimum volume commitments in there. And for us, our GTC costs run 25 to 30 cents, and in the Marcellus, on average, those run closer to $1.20. Some are down to 75, some are up approaching $2. So when you put all that in on a cash margin basis, the Haynesville is one of the best plays in North America from a pure cash margin because of the cost structure.
Thank you for that, Alan. And my last question for you really is kind of a 3-part question, I guess. What do you think is the path forward from here, not only for Rockcliff's interest, but the Haynesville, and then also the industry as a whole as we move forward?
Yeah, that is definitely the $1 million question. What does the future hold, and what is the investor appetite, and what is the investor looking for? What we've seen over the last couple of years is the investor in the E&P space has gone to more what we call a fundamental analysis that they would do of just about any company. And when you do that, you really begin to focus on the cash flow, the amount of leverage that the company may have. And those are two of the huge drivers when they begin to grade out which company has the best acreage, which company has the best balance sheet, which company is one that they would prefer to invest in. So I think that is really what the investor base that has sort of, fleed energy. And for those who are still here and for those who are considering coming back, they're really looking at, what's the cash flow yield? How much free cash flow does exist? What is the true return on capital employed? In other words, you're investing all those dollars, production growth doesn't really matter. Reserve growth doesn't really matter. What am I getting for those invested dollars? And what is that return on capital employed? And are you being disciplined in living within your cash flow? We're a growth company. So when we start from scratch with a lot of acreage and a little bit of production, we had to build it up to where we are today. We're approaching, a point where we'll be free cash flow neutral next year, and then we'll become free cash flow positive here over the next 12 to 18 months. So I think, again, what is the investor community is looking for is a set of assets that has low leverage, that has the flexibility to be able to ramp up and ramp down based on commodity prices, but still maintaining that discipline of free cash flow and return on capital employed. And I think that for those companies that meet that criteria and have those attributes, I think they're going to do well.
We certainly appreciate hearing that and you sharing your expertise, Alan. I look forward to being able to hear your insights again, of course, for Doug Haynesville in October. Thank you very much for everything that you've done over the years, and best of luck to you as well.
Great to be with you, and really appreciate it.
Thank you so much.
For more Hart Energy videos, follow our social media channels.